All right, today we are diving deep into the world of corporate finance, specifically looking at something called intra-group loans. We're going to pull back the curtain on the first four absolutely critical steps that auditors take when one company in a group lends money to another. Think of it as high-stakes financial detective work.
And that brings us to the million-dollar question that really drives these investigations. When a parent company gives a loan to its subsidiary, is it just a smart way to move money around, or is it a clever trick to shift profits and slash the tax bill? That is exactly what auditors are paid to find out.
So, just so we're all on the same page here, an intergroup loan is pretty much what it sounds like. It's a loan between two companies that are part of the same family. A parent company lending money to its own subsidiary. The concept itself is simple, but as you'll see, how it's done is where things get complicated.
Here's what we're going to cover. First, we'll look at the big puzzle. Then we'll walk through the 4 key steps an auditor takes. Step 1, proving the loan is even real. Step 2, checking if it looks like a normal loan. Step 3, asking if it was actually necessary. And Step 4, the big business purpose test. And then we'll wrap up by looking at why all of this matters so much.
Okay, so this whole investigation really hinges on one single fundamental idea, the arm's length principle. Now, what that means is that any deal between related companies has to look exactly like a deal between two complete strangers. The big puzzle for auditors is always, would a real independent bank have offered this exact same loan on these exact same terms?
So let's jump right into the first step. Before an auditor can even think about whether a loan is fair or not, they have to answer a much more basic question. Did it actually happen?
Right. The first job is to prove this isn't just smoke and mirrors. Is this a real financial transaction with real money moving around, or is it just a ghost entry in the accounting books created just to get a tax deduction? The first challenge is to prove it's real.
So how do they do that? Well, they start gathering evidence, like detectives. They'll demand to see the formal loan agreement. They'll trace the bank transfers to prove the cash actually moved. They'll check the books of both companies to make sure the story adds up. And, maybe most importantly, they look for proof that the loan is being paid back.
And here's Exhibit A in their investigation, the actual loan agreement. This isn't just a piece of paper. An auditor is going to scan this thing for all the hallmarks of a real loan, a specific loan amount, a clear interest rate, and a firm date when it all has to be paid back.
Next up, you gotta follow the money. This bank statement right here, this is Exhibit B. This is the hard proof that the loan wasn't just a promise. Cold, hard cash actually left the parent company's bank account and landed in the subsidiaries. This is what gives the loan real economic substance.
And here it is, the final piece of the puzzle for Step 1, the repayment. See, a real loan is a two-way street. It has to be paid back. This document shows the borrower actually making a payment with interest. It proves both sides are treating this like a real debt, not just a free cash handout.
Okay, so step 1 is done. The loan is real. Now we move on to step 2, which is, does this loan behave like a normal loan? Does it look and feel like the kind of loan you or I would get from a bank?
Essentially, the auditor is holding this intergroup loan up against a regular third-party loan to see how it compares. If the terms look pretty standard, it passes the sniff test. But if anything seems weird or way too generous, that's a massive red flag.
So they have a sort of checklist. First, does it have a clear end date? A loan that never has to be paid back, well, that looks a lot more like a gift or an investment, not a loan. Second, as we already saw, is it properly recorded on both sides? And third, and this one is a big one, could the subsidiary have actually gotten a similar loan from a real bank given its own financial situation?
All right, now for step 3. Let's say the loan is real and the terms look normal. Auditors still have to ask an even more fundamental question. Did the company that borrowed the money actually need it?
To figure this out, they have to dig into the why. They'll interview people to get the story behind the loan. They'll crunch the numbers to see if the subsidiary was really short on cash. They'll even look at the parent company to make sure it was actually in a position to be acting like a bank in the first place.
And that leads us to our fourth and final check in this initial phase, the business purpose test. It's not enough that the company needed money. The auditor has to verify what they did with that money.
What this means is that the borrowed money had to be used for something that helps the business make more money and therefore generate taxable income. So, if they used it to build a new factory or launch a new product, great, it passes the test.
But if that money just sat there or was used for something that doesn't generate income, that loan is going to be in big trouble.
So, we've walked through these 4 steps, and you might be thinking, okay, what's the big deal? Why go through all this trouble? Well, the stakes are incredibly high because this audit can have 2 very, very different outcomes. This slide says it all. If the loan passes these tests, everything is fine. It's treated as legitimate debt, and the interest the company pays on it can be deducted from their taxes. But if it fails, the tax authorities can say, nope, that wasn't a loan, that was an investment. And just like that, all those tax deductions are gone. And on top of that, you're looking at a bigger tax bill plus penalties and fines. You know, at the end of the day, it all comes down to this idea right here. You can have stacks of contracts and perfectly filed paperwork, but if the deal doesn't have a real business reason behind it and doesn't have a real economic impact, it just won't hold up. Substance is everything.
And that leaves us with one final big question to think about. These 4 steps give us a framework, sure, but they also shine a light on this constant tension in our global economy. Where exactly do you draw the line between a company just being smart with its money and a company that's actively trying to bend the rules to avoid paying its fair share? That's the question that companies and tax authorities around the world are wrestling with every single day.